Welcome to our weekly forecast. My name is Jay Norris. As always, we need to remind you that trading Forex is a risky endeavor and not suitable for all investors. As I said, my name is Jay Norris. I've written a couple of books on trading, which were published by McGraw-Hill and serve as the textbooks for our courses. I'm also the Director of Education at Trading University. First market we're covering is the Australian dollar. I've been telling clients lately that I'm a little bit leery of being long now at these levels because you couldn't punch through the late summer highs in December. If ever there was a time where you would have thought you would have made a higher high and had a pretty good run of things, it would have been during those slow months of December. But the market just couldn't overcome the selling pressure. Now I'm afraid we're at a level here where this becomes a risk tolerance level where we may have a bit of a battle on our hands here. I'd be definitely leery about initiating long positions at these levels, adding to long positions. I'd definitely rather be patient and wait. Now, if you are long, you just got to kind of sit there and take it. The last thing you want to do is put a stop too close. Ideally, if you're long this thing as an investor, I think you have to risk it to 103. And I don't even want to say that because at 103, I'd be initiating positions here. Long term, there's no doubt about it, the secondary pattern's up, the primary pattern's up, the day-to-day is still up also. But, you may be in a position now where because this guy failed to push through those levels over the holidays, that you may see a little bit of downside. Long term, though, I don't think anything's happening. I think this just may be a shorter term development now. So let's keep an eye on it. If I like it overall now, I'm going to love it at 103. If I love it at 103, I'm ecstatic at getting a shot at 101. We have to keep an open mind here. There's a lot of reasons to like this market long term. And we'll cover some of those when we look at dollar yen being one of them. Timing is everything in this business. So next market, euro US dollar. Here's another one where timing is essential. You can see you've had that secondary up, that day-to-day up, and we've really enjoyed that. This is a beautiful 50% retracement there. You see it retrace that move 50%. At that point, the day-to-day and secondary were already up, so that was easy. Kind of easy pickings here. Very similar. You retrace 50% of the overall move. See that purple line there? Same story. You retrace 50% of that move. You didn't quite shift that day-to-day either, so a little bit simpler to handle. Secondary was up. Day-to-day was up. Now, the closer you get to this band of resistance, 135, all the way up to 138, the chart may get smaller. We liked the euro when you had room to 135. The closer it gets to it, however, the chart I think can tend to get smaller there. I don't think this market's quite ready to turn around yet. We'll have to see. I do think that long term that you will get a turnaround here. Let me pan out to the weekly, and I think the fundamentals will dictate what's going to happen. Long-term fundamentals as far as really negative demographics in Europe. There's nothing new there. No matter how you cut it, even if the European banking system is on the mend, and by the way, a strong euro helps them mend too. That's not necessarily good for sales for businesses, but for bankers, it's not a bad thing at all because the money that they had lent out at these higher levels, what gets paid back comes back at those same levels ideally. A sharp sell-off in the euro wouldn't be good at all because then the money getting paid back to the bankers is coming back at a lower rate. So if you can prop up the euro, that's long-term bullish for European banks. But my point being, even as the European banks start to mend, in comparison, they're still going to be weak to other money centers. So long-term, I just don't see a whole lot of upside quarter to quarter, I should say. Now that doesn't mean that you can't run stops above 135, even in outside chance you see 138 and a half, 139. However, those would really be areas where I would be interested in stepping up and taking a shot at a counter trend trade even. I think if you had like a double top against 135, that probably wouldn't be a bad area to take a shot at a counter trend trade. And I'm a trend trader also. So that's where we're at here. It's eventually those fundamentals will pan out, and longer term, where would you want your money? Perhaps U.S. companies where you're seeing positive GDP growth, you're seeing positive retail sales. You want to keep it in Europe, or maybe you take a look at down under in Australia, New Zealand. Although I understand, the Australians are having problems too. You had a couple of bad employment numbers month to month. Your economic sentiment numbers aren't as glowing as they once were down under either. But on the other hand, from my perspective, it's still better than the euro. So I don't think euro, however, is ready to go down yet. I think you have to respect the timing of the technicals, and it could creep along up here for some time, months even. But I think the closer you get to spring, the more hard of a look we'll take at any kind of bearish formation in this zone, really, between 135 and maybe 139 on the upside. Let's take a look at the pound. The pound dollar was a great market for us. This is what we were focusing on all week for our clients. We sent out a little note, I think it was Wednesday night. Hey, we're focusing on this guy. We had fun with it all week long, actually. And now, however, boom, you drop down to that support. So that was our target, that purple line. Boy, you got there a little quicker than we thought, but nonetheless, you got there. We're definitely still interested in selling rallies in this market. But what's most interesting to me about pound right now is this a leading indicator for us? Is weakness in the pound foretelling that we're going to see weakness in the other markets? It's also interesting, too, that we're finally seeing a breakdown in the correlations in these currency markets. The currencies, commodities, they were just a slave to the U.S. stock market really since QE1 in 2009. And now we're seeing that breakdown. We saw it break down in the gold, which we'll cover in a little bit. This is what we saw this week. Are we seeing a breakdown where the currencies are starting to go their own way? You had the opposite picture in the U.S. stock market this past week where they were just continuing to power higher. So to me, I think that is a strong possibility that as you get nearer to the end of the QE cycle, the quantitative easing cycle in the U.S. anyway, I think you will see QE going forward in Europe, maybe even a continuation in Britain also. But I suspect that powerful correlation where you had the stock market was playing the role of the alpha market, I think that's breaking down, at least for the pound. So that's the big question. Is the pound a leading indicator market? So stay tuned. We're going to find out, right? Next market we'll take a look at would be dollar yen. Dollar yen, that's been a heck of a big rally. We wrote about that. We've been talking this market up, writing bullish commentary on it all the way back to the fall of last year. And let me just put this in perspective. A lot of traders, they look at this chart and they go, well, it has to come down. Well, markets don't have to come down when they have momentum like that. It would be nice, though. But let's take a look at this on the weekly chart and put it in perspective. Here's our overall upside target, and that's very simply that par level there, 100, the purple line. That's just a 50% retracement of this bear run here. So from my perspective, par is obtainable. Now, I don't think it's going to go right there now. Markets being what they are, there's always an element of unpredictability to it. We'd like to see a correction. We'd like to see some sideways price action. But never argue with the market. We're still very bulled up on this market. As I said, I think it goes to par. I don't know if you'll get there this year. I'd like to see a correction. I'd like to see some sideways action as this market consolidates its gains, but you just never know. You have to view currencies from a longer term perspective. You're going to benefit from viewing them from that long-term perspective and from considering trading them smaller. Don't look at them as a trading vehicle so much as an investment opportunity also. Take advantage of the mini contracts. Take advantage of the micro contracts. And get used to seeing how markets move through time like this, and over time you're going to figure out how to take advantage of that for yourself. Hey, let's cover the gold market. I had mentioned that. Here's another one where you really saw a breakdown, especially at the end of the year. You had a serious breakdown in the correlations between stocks, currencies, and commodities. Gold, in this case, kind of hybrid currency, definitely a commodity. You saw some real weakness year end. And here's another one where you have to question, is that a breakdown in that correlation? I think it is. I think because the QE is closer to the end than the beginning, definitely, that this will have an effect on these markets. Let's take a look at the weekly gold chart. And if there's one thing you definitely need to understand about the metals market, about gold in particular, is we don't see gold having gone from 800 to 1800 because the economy slowed down or there was a threat of a crash in the economy. We saw gold going from 800 to 1800 because of what government did, because of quantitative easing back in '09. Quantitative easing was very bullish for gold for sure. So keep that in mind. Did gold go up because there was a threat of an economic slowdown, economic meltdown, like a lot of people talked about? Or did gold go up because there was just easy money and there was nowhere else for that money to go? And easy money is going to go for the momentum. Hedge fund traders, short-term traders, even intermediate, long-term traders, they go where the momentum is. So gold was just a momentum play. It'll be interesting to see what happens to gold going forward. You're at actually a shorter-term level right now. Just these highs. So I think if you can get out above what is that 1700, then maybe you have a shot at 1750. But I'm not so enamored with gold yet. It's really got to show us that it can make a move. You have to be disappointed in gold's performance, even if you're a staunch gold bug. You have to address the problem of what happened at year end here, where gold just went soft. In effect, it was heading south in the face of a very strong stock market, in the face of a strong dollar yen. Now, why should dollar yen be supportive of stocks and the other currencies? Why do I see a strong dollar yen as such a bullish event? Well, Japanese investors have to get out of yen now. No doubt about it. First, the yen shifted its day-to-day pattern back in the early fall. Then it shifted that secondary pattern higher. Now it's actually shifted its primary pattern bullish. So not only it's shifted, but of course it has the support of the new administration in Japan, the new leadership in Japan. They're all for a weak yen also, and that's what we saw throughout the week as far as the back and forth between Abe and his chief finance minister. Also kind of a little bit of an argument back and forth there. But what happened, the dollar yen closed strong, yen closed weak. So you see that the government's getting their way also. What does that mean for Japanese investors? They have to get out of yen. Literally, they have to move out of their home currency, and they need to start spreading their money around the globe. They have to do it wisely. So to me, I think long term you'll continue to have a bid in Aussie government debt. Long term, you'll continue to have a bid in U.S. blue chip stocks as Japanese money comes out of Japan and they have to go to work. They have to put that money to work somewhere else. So a weak yen, very bullish overall for the global economy. Why hasn't that money gone into gold itself? Well, I'm not quite sure, but I think it's kind of safe to say that the Japanese may have enough of the gold, or they just don't see it. They see it as more of a commodity where you have to pay to store it. There's certainly no dividend that comes along with gold. You have to see higher gold prices to make money in gold. You have to, because you're paying to store it. It is a commodity. There's no dividend to it. Certainly no interest rate to it. So if you're a gold bug, you have to address why hasn't gold strengthened as dollar yen strengthened, as everything else strengthened. Gold didn't. So you have to address that. And if it can't get beyond the January high there, just that little sticking point there, just below 1700. If you can't get below 1700 and you come down and you test that 16 and a quarter, I think gold's in trouble. We'll have to see though. It's a tricky market, and it has a tendency to look really bad technically and then come roaring out of there. So let's keep an eye on gold. Last market we're going to cover is the U.S. stock market. Looking good. It doesn't get much better than that. Look, you had a little bit of a sticking point there. You had a GAN line, an 875 line there, closed above it. You had two closes above it, in fact. So you have two closes above that significant level there. Pan out to a weekly line, weekly chart, and you can see, hey, you're in. You've got the all-time highs in sight. It'd be hard to imagine that this time of the year that you're not going to go for that. You have a pretty good bullish season on the stocks right now, so kind of hard to imagine that you won't go for that all-time high there. And certainly you can see the primary up, secondary up, day-to-day up. Definitely not a market that you would want to be short of. And keep in mind, too, that the only country out there that we're seeing putting up pretty good economic numbers is the U.S. of A. You had pretty good retail sales numbers. Now, granted, you're your consumer confidence numbers came down a little bit last week as everyone starts to feel the pinch of that 2% tax hike. But longer term, the economic problems we've seen that started in essentially '08 and really accelerated. Started in '07, accelerated in '08 and '09. That wasn't the consumer caused that. That was essentially the banks themselves got themselves in trouble. So, hey, the consumer in the U.S. is still alive and well. The big question is, everyone's taking a 2% tax hike hit, essentially. So we'll have to see how they hold up. But the U.S., it's holding up better than most places we see around the globe. So from a relative perspective, the U.S. is doing okay. Thank you so much, and we'll catch up with you again for the midweek Forex forecast. Thanks now.